Good afternoon. My name is Carrie Holloway. I'm a CRA officer at the Bank of New York Mellon and a NAAHL board member. Today we've had the opportunity and we've been the beneficiaries of past, present, and future perspectives on CRA supplied by a full spectrum of vested interests, including elected and government officials, bank and mission-based lenders, regulators, and academicians. To that end, I have the pleasure of introducing someone I'd like to call today a CRA practitioner, Jennifer Tescher, from the Center for Financial Services Innovation. I don't have to read her bio, it's in your conference package, but what I think is most important to say about Jennifer and her organization is that it is an authority on consumer health and leads a network of financial services innovators that are building consumer products and practices through technology for those consumers who need them the most. Her organization also conducts research and develops data, provides consulting and advisory services, and runs a financial solutions lab. The lab was co-sponsored by JP Morgan Chase, helps community startups, which are both financial services organizations and nonprofit organizations, help consumers save, improve their credit, and build assets. Jennifer.
Thanks, Carrie. Good afternoon, everybody. How are you? So, Buzz and John, thank you so much for inviting me to be here today. When they called, they asked me to come and talk about the state of the financial services industry and the digital revolution. And I thought, well, that's appropriate timing because as CRA turns 40 this year, the iPhone, as you probably know, just turned 10. But to think about the future of CRA, we also really need to understand the state of the financial lives of Americans and understand what they need from financial services providers. I think we should always start the conversation with the consumer because when people's financial needs aren't met, their communities suffer, and vice versa. Shortly after the birth of the iPhone in 2007, we experienced a financial crisis and a recession that laid bare the fact that millions of Americans, frankly, the majority of Americans, were really struggling financially, and somehow we had missed it for decades because their suffering had been masked by over-indebtedness. Today, many Americans appear to have the trappings of success. They have jobs, homes, health insurance, retirement accounts. But if you look past the veneer, you see that they're experiencing an unsettling level of financial fragility, stress, and reduced confidence in the future. The statistic that I hear most frequently quoted is from the Fed, the fact that nearly half of Americans couldn't come up with $400 in an emergency. Now, there have been numerous macroeconomic and structural explanations for where we find ourselves. Stagnant wages, globalization, the fraying of the social contract between employer and worker. But little to no research had been focused on what was happening in people's day-to-day lives. And we set out to fill that gap 7 years ago, if you can believe that, through our Financial Diaries research. Some of you may be familiar with it. We followed for a year 235 families living in 4 different communities around the country. And we kept track of every dollar, essentially, that flowed in and out of their lives. We sent field workers to visit them every 2 to 4 weeks. And we really came to understand not just how money worked for them, but the decisions and the context behind many of those decisions. The book was a joint effort between CFSI and NYU and was co-authored by Rachel Schneider and I'm now forgetting our co-authors. Thank you. It's so small on the background. That's a really bad fail, since I've only been working with them on this for 7 years, and Jonathan Morduck, a noted economist at NYU. And I really encourage you to take a look. But some of the most critical findings are these. First, we uncovered a tremendous amount of volatility, income volatility in people's lives. And other research has demonstrated that volatility is increasing for all of us. It's happening for a variety of reasons. But what that means is, on average, the families in this study, who ranged from poor to working class to middle class, I would say, were on average 5 months out of the year experiencing a spike or a dip in their income that was plus or minus 25% of the average. So I'm not just talking like a little blip. This is a very significant spike or dip. And most of the time, the spikes and dips in income don't match up with the spikes and dips that they find in their expenses. And expenses aren't nearly as steady as we would expect. So people might look okay on an annual basis. We look at average incomes a lot in this country, median incomes. And if you look on an annual basis, a lot of folks, their income and expense matches up pretty closely. But people don't live annually. They live day to day, week to week. And that's where people are getting stuck. They're getting caught up. And it's creating massive financial stress. Takes up tremendous amount of bandwidth. People are spending huge amounts of time trying to manage these cash flows. It also makes it very difficult to plan. It makes it difficult to put aside money in savings. And despite what all the economists tell us about how we start off young, we work hard, we start to save gradually over the course of time as our incomes rise, and then we hit this magic retirement moment, and all of a sudden we're all ready to live the good life, most people don't experience life that way. And in fact, for the people in this study, a more apt metaphor would be the rocky road, that they are constantly driving on a jutted and rocky road. I'm sorry, much of this beginning is going to be kind of a downer. I know it's been a really up day, but we are talking about CRA, and we can't not confront what millions of Americans are facing. Now, at the same time that all this financial uncertainty is going on, technology is upending everything else. Nope. It's hard to overstate just how revolutionary the iPhone was. It is truly like carrying around a computer in our pocket. Our phones have more computing strength and power than what was used to launch some of the early rockets into space. And in a decade, nearly everyone in the US has now bought one. The Fed's research shows that as of 2015, 87% of the US adult population had a mobile phone, and that 3/4 of those phones were internet enabled. Mobile technology is changing everything, including how people manage their financial lives. So about half of all mobile phone users with a bank account had used mobile banking in 2015, up from 33% just 2 years earlier. And I can tell you that the number, when the Fed comes out with its next study from 2017, will be even higher than that. And banks are responding. So one top 10 bank reported that in 2014, tellers were handling only 42% of all bank deposits, down from 90% in 2007. That's staggering change in such a short period of time. One report forecasts consumer visits to retail bank branches will drop 36% between this year and 2022, with mobile transactions rising 121% in the same period. And another report suggests banks will shed 20% of their branches in the next decade. Now, I'm not here to argue with the predictions about whether branches are going away entirely or not. I will tell you, I don't think they're going away entirely. I think there will be fewer, and I think already you're seeing branches play a very different role, and many institutions are already experimenting with different roles branches might play. It's exciting for me to think about the fact that mobile banking and mobile apps are increasing reach and convenience while reducing costs and taking friction out of the system. And as that happens, financial services is actually becoming less about moving money and more about leveraging data. Through advances in computing power and increase in machine-readable data sets, providers can use a wider array of data types to know the customer, enabling them to reach more people with both deposit and credit products, particularly the 26 million credit invisibles in this country. Providers are also using data to provide more and better real-time advice to help consumers manage their finances and make better financial decisions. Increasingly, banking is not about products, but about experience. I used to put up a slide that showed a guy standing at a checkout counter, and his credit card was on the table, and it had a little speech bubble coming from it saying, like, hey, dude, put me away, you can't afford that. And 10 years ago, that was funny. It's not funny anymore because technology is enabling that to happen, and those kinds of alerts are actually happening. It's also not just about banks anymore. Of the 11% of consumers who left their bank last year, 35% went to a non-traditional provider, including online-only banks, payment services like PayPal, rather than another bank, according to an Accenture survey. And that figure is up from 16% in 2012. So again, this is rapid change very quickly, real true disruption. FinTech has actually become a big business. Global investment in FinTech startups is at over $12 billion just through the third quarter of this year. Both banks and FinTechs have come to realize that they have more to gain from partnering with each other. It's no longer a discussion or an argument about who's going to win. And since 2012, the top 10 US banks have invested $3.6 billion in 56 FinTech companies. As Carrie mentioned, CFSI is also working in FinTech, and through our Financial Solutions Lab, we now support about 26 FinTech startups who are building businesses that are really addressing consumer pain points, financial pain points. Collectively, those companies are serving about 1.5 million consumers, many of whom are low and moderate income. Now, I am not one of these people who believes that tech's going to solve all of our problems. And the fact is, it can create as many problems as it solves. Technology and innovation isn't a good thing or a bad thing, it's just a thing. But I do believe that we should be doing everything we can to leverage its power while mitigating the risks. Now, I could go on about how technology is changing everything, but I can tell you one thing technology hasn't changed: CRA. As a result, CRA is becoming an increasingly less effective lever for addressing two of the most critical trends of our time: the poor financial health of Americans and the opportunities that technology innovation represents to help improve it. CRA's goal is meeting the credit needs of low and moderate income communities and the families who live in them. And CRA has been particularly effective in spurring the development of critical neighborhood infrastructure. And there's no doubt that community investments and mortgage and small business lending are vital. But given the sad state of Americans' financial lives, it's problematic that CRA treats consumer non-lending activities as merely supplementary. CRA is clearly a motivator still for banks once they're engaged in a merger or have had a regulatory problem, as evidenced by the recent stream of CRA agreements with massive financial commitments attached. However, the current practice of simply counting dollar inputs, hours spent in financial education, or numbers of people served doesn't ensure the outcomes we want. In fact, the outcomes for the recipients of those loans or services aren't even really part of the calculation. Now, part of the challenge is that CRA assessment areas are tied to deposits, physical facilities, and geographic boundaries at a time when financial services is rapidly transforming to a digital business. In addition, CRA focuses exclusively on low and moderate income neighborhoods, while nearly 3 out of 5 families are struggling financially. While we should continue to focus on these low and moderate income people who are absolutely most challenged, we have to recognize that Americans making well beyond 80% of median income are also really struggling. They're not going to be candidates for mortgages and small business loans. Finally, the industry's disruption wrought by technology has transformed the financial services ecosystem, yet CRA governs only banks and thrifts. Meanwhile, the broad array of non-bank actors is growing in assets and in the number of customers they serve, in some cases including the low and moderate income customers we care most about, but we haven't invited them to the party. Now, I feel a little like a skunk at the garden party. But let me be really clear. I believe wholeheartedly in CRA. As a product of ShoreBank, I'm steeped in CRA. And I believe it has dramatically changed the way banks see and serve low and moderate income consumers. I just want it to keep working, to reflect the times that we're living in, not the times when it was originally created. While we still have challenges and problems in the world that need solving, they are different problems than we faced when we enacted CRA 40 years ago. I believe that our thinking about the future of CRA must be informed by the collision of the two trends I discussed: broad financial instability on the one hand and technological innovation on the other. And so in that spirit, let me come to the positive part of my remarks. Let me share my vision for what I think CRA could look like in the future. It starts with reimagining the purpose of CRA to go beyond credit. I think CRA should be aimed at improving the financial health of consumers, small businesses, and communities. I've been talking about financial health this whole time, but I actually haven't stopped to define it for you. This is how we define financial health. It comes about when your daily systems help you build resilience and pursue opportunity. Now, that's a lot of big words. It essentially just means we need both good products and institutions and access and decision-making so that we can avoid the downside and take advantage of the upside. It's what all of us are trying to do every day. And if this is what we're aiming for, then we need a more robust set of solutions that are all seen as equally valuable. So for consumers, credit needs should include more than mortgages, and services should extend beyond financial literacy and financial education to include innovative business models, products, and initiatives. Moreover, I believe CRA needs to better align business outcomes with customer outcomes in ways that are objectively measurable so that everybody wins. That's why we've created a set of indicators for consumer financial health. These are the R8 indicators, and we have in great detail what metrics look like, how you could use your own data or survey data to track these kinds of things, and have been working now with 20+ financial services companies who are using a combination of their own data and survey data to diagnose the financial health of their own customers. And we've also been working on a set of indicators like this for small business financial health. And we also are clearly going to need something similar for measuring community financial health. The way that we measure success in CRA really needs to focus on outcomes, not outputs. In an era of internet and mobile financial services, more people have more access to a wider array of products and services via more channels than perhaps at any time in history. Now, rather than see that as a threat, we need to leverage it to reach broader and deeper. We need to rethink assessment areas. For community development investing, we need to give digital institutions broader opportunities for investing in neighborhoods of need, regardless of the location of their physical headquarters. For lending and other services to individuals and small businesses, we should enable providers to target people in need, regardless of whether they live in a particular branch footprint. If we really want to leverage the power of technology to improve financial health, CRA needs to incentivize technology development and delivery aimed at harder to reach places and people. You heard mentioned just earlier the challenge of serving rural America as an example. Or I like to use the example of Wi-Fi in branches. There are very few places you can walk in today that doesn't have Wi-Fi. Banks would be among them. And the banks that do have Wi-Fi tend not to put them in low and moderate income branches. And that's where they're needed the most. That is where they're absolutely needed the most. Why shouldn't we be incentivizing that? My soapbox idea that I have been offering up for years now, if anyone wants to do this, please come see me. We should be rethinking, as I mentioned earlier, the role the branch plays. So why not take money, CRA money, and use it to give everyone in a particular low-income community a device, a phone, a tablet, and a year's worth of data that they can access from their home, and then start to work with them digitally, and then use the branch in that community for more intensive engagement. There are tons of different things we could be doing with technology that would give low and moderate income people and communities a leg up in what is becoming a digital society, and that would really help our overall goals of financial health. Once we've done all of that, we should consider expanding CRA beyond banks to include a wider swath of financial services providers, mortgage companies, credit unions, and perhaps even a broader array of providers, consumer finance companies and other lenders. How about prepaid card programs that are starting to lend, or other fintech app companies? This slide, I don't know if any of you have seen it before, but this is a slide that takes a snapshot of the homepage of Wells Fargo. I didn't build this slide, sorry, Wells Fargo, but I'm sure you've seen this many times. And it shows all of the different fintech companies and providers out there who are doing some piece of what Wells Fargo does. This is a great image to just explain how diversified the financial services industry is becoming. And we've got to, if we're going to make a dent in this problem, if we want to make a dent in the financial health crisis in this country, then we need everyone in the game. We need Wells Fargo and all of these companies in the game. For too long, we have been talking about CRA modernization as a series of tweaks to the existing model, in part because of real political realities. And I'm lucky because I get to come here and just lay out the vision. I don't have to talk about like the plan, how we're going to get it done. But I think with what some of you might think are incredibly crazy ideas, we're not at the plan yet. We're really at the very beginning of needing a new conversation. And I'm here because I want to be in conversation with all of you who have tremendous expertise in CRA and in serving these communities. So I hope we can start that conversation today, because that's how we're going to get to the NAAHL CRA Begins at 80 conference. Thank you. So I think we have time for a little bit of Q&A. I'm happy to take questions.
Jennifer, that slide, the last one about unbundling of the bank, was sort of fascinating. You have such a perspective looking at banks and non-banks. I wonder if you could just talk about how you see those two worlds, more aligned or less aligned. In other words, for companies that serve consumers with financial services, how do you see them, again, compare or not in terms of the types of products that they're offering, the cost of those products, the delivery of those products, and the terms of those products? And I'm asking just generally in terms of how you see it, but I think also there's sometimes a perception of what a non-bank company does and how well that serves, as opposed to a regulated institution. But I'm asking in the broadest sense.
Sure, I appreciate that question, Dan. I'll just be blunt. In the past, when people have thought about alternative or non-traditional financial services, that was really code word for check casher and payday lender. We talk with those people too, but this slide and what I think represents the future is not that. It's different. And I can't say that every single product or service out there is great, but I can't say that about banks either, right? So, but we see a lot of tremendously interesting, high quality offerings for the consumer. And I think and for small business for that matter. And in many cases, these companies are either now becoming B2B. They're providing services to banks. In some cases, they're going to provide to the consumer through a bank, so it's B2B2C. So there are all kinds of different and very interesting business models. And the reason for that is this is really about who manufactures the product versus who delivers the product. And many, but not all, of what you see in fintech land is a lot about delivery. It's a lot about the customer experience. It's about what this looks like and how well they're able to engage and attract folks in and keep them sticky. And some of them manufacture their own product, and others don't. They've got a bank behind them. And I don't think they have a bank behind them necessarily for nefarious reasons, like they're renting a charter. I'm sure there's some of that. But in many cases, that's how our regulatory system works. And at the beginning, I think a lot of banks felt very threatened and concerned, oh my gosh, and there's still some of that. But most of the folks up here are, let's be honest, are still relatively small, certainly relative to the ginormous financial institutions in the world. And many of them, they can get to some level of scale, tens of hundreds of thousands, maybe in the early millions, but they don't have the customer bases that the big banks have. And the big banks don't necessarily do as good a job at the customer experience. And so thus a marriage is made. So we're seeing all kinds of very interesting partnerships, ways in which these firms are engaging with each other. Sometimes they're just being acquired. Sometimes banks are acquiring them just so they can use the talent to set up their own innovation labs internally. It's a very interesting and robust time in that space. And I don't think that it's a panacea. I just think that there's a lot of fertile ground there. For many of the customers that we care about, some of these products, whether or not they're yet aimed there or not, can be very effective at dealing with some of the consumer pain points that I mentioned earlier.
Have you had an opportunity to lay out the number of young ethnic groups that are coming in and using obviously the cell phones for communicating with each other and so on, and specifically for Latinos?
So I don't have the stats off the top of my head. I can tell you, on the one hand, that all of the data and examples I gave about the financial challenges that Americans face, it's all worse for people of color, both blacks and Latinos. I'm not telling you anything you don't know, but it's important to mention that, so thank you for raising it. And as it relates to mobile penetration, mobile usage, people of color and low and moderate income people oversample in their ownership and use of smartphones. And just to be clear, for a lot of folks in those communities, this is their computer. No joke, right? This is their access. It's very important to them, right? Just how we couldn't imagine living our lives without one. It's super important when you don't either have a computer, you don't necessarily have Wi-Fi in your home, et cetera. So that's why I'm partially so excited about it. It's not like we have a big sell there to do to reach the consumers that we care about most.
Hey, Jennifer. Corey Carlisle with the ABA
Oh,
Foundation.
thank you.
Good to see you.
Hi.
Thank you so much. Fantastic presentation. So, and this is kind of actually piggyback on what you just talked about. And you've done so much discussion around what it means to be banked, unbanked, underbanked. Seems to me an evolving definition. And in this new rubric of what you see CRA keeping up, do we need to also be thinking differently about those definitions?
I'm glad you asked that. So Corey's known us a long time. when CFSI started life almost 14 years ago, we were really the un- and underbanked people. Our mission was to shine a light on un- and underbanked people that weren't yet in focus for us. And this was 2004, so it was pre-iPhone either, but even then we could see technology changing, and to leverage technology to help reach and serve them, provide access. But when the iPhone came along, access became ubiquitous. And over the course of time, given all of the things that happened, the crisis, the recession, trends in Silicon Valley, it became clear that a focus on the un- and underbanked was like focusing on a poorly defined problem as opposed to focusing on the outcome we wanted. And so we went back to the drawing board and said, what is it we actually want for people? And what we really decided we wanted for them was financial health, because it's so deeply intertwined with their health. And so as we go forward in thinking about CRA or any other kinds of regs where we're trying to bank the un- and underbanked, it's very important that people should have access. Leaving aside credit access, I think basic access to transactions, payments, systems, et cetera, we've never had more options, more choices for everybody. I think we're probably out of time. Someone more important than me is waiting to speak. So thank you very much.